Hello and welcome to interest.co.nz. I'm Gareth Vaughan with another Double Shot interview. I'm here with Dan Bell, who's Director of Sales at HiFX, here to talk about everything to do with the world of currencies. Welcome in again, Dan. Good to see you.
Thanks, Gareth. Good to be here.
Now, real New Zealand dollar weakness story at the moment, or is it? The Kiwi's down, sort of getting down towards 70 US cents. What's going on? What's driving this?
Yeah, that's right. So the New Zealand dollar traded under 71 cents this morning against the US, which is the lowest level since 2010. So looking at the lowest rate that the Kiwi's been in 5 years. And we saw some weakness overnight in the New Zealand dollar and some strength in the US dollar on the back of some better manufacturing data out of the US, confirming that the US economy continues to perform quite strongly. But also over the last few days, we've seen more of the market start to price in chances of interest rate cuts from New Zealand. So the Reserve Bank of New Zealand has the cash rate announcement next week, and the market is now pricing in about a 56% chance of a rate cut at that meeting. So interesting to see that come into play, and that's seeing the New Zealand dollar weaker now against most of the major currencies over the last couple of days.
Now, you mentioned that OCR review next Thursday, so the market expectations are building for a cut. Be interested to get your views on what will happen to the dollar, I guess, one, if there actually is a cut, and two, if there isn't.
Yeah, so certainly if there isn't a cut, I think the RBNZ will have a definite easing bias. So they're already starting to talk about room to cut interest rates in New Zealand. I think they'd lose a bit of credibility if they don't follow through with a clear easing bias next week. Obviously we've seen significant weakness in dairy prices over the last 12 months. The general feeling is that demand, aggregate demand in the New Zealand economy is starting to come off the highs that we've had sort of last year. The Christchurch rebuild is not quite sort of run its course, but it's starting to sort of slow down, and perhaps the strength that we've seen in the housing market in Auckland, whilst it's still a big story, perhaps isn't sort of bubbling along at the rate of knots that it was last year.
Okay. And before then, we've obviously got the Reserve Bank of Australia with their latest review of their cash rate this afternoon, in fact. What's the expectation out of that one?
Yeah, so no change expected from the Reserve Bank of Australia today. Their cash rate is already down at 2%, so record lows for the Australian cash rate. In Australia, we're seeing ongoing weakness in business investment. So their capital expenditure numbers last week, again, much weaker than expected, and just reinforcing that the softer resources and mining sector continues to have a big impact in Australia. On the other hand, building approvals and retail sales are doing quite well in Australia. So again, these weak, lower interest rates in Australia are supporting house prices, supporting construction activity, and supporting consumer confidence in retail sales. So you are seeing a little bit of strength in that side of the Australian economy. We know that resources and the mining sector is still under pressure. So the Australian dollar still relatively weak to where we've been. It's at 76 US cents at the moment. And again, that's being driven lower by the stronger US data that we've been seeing recently.
Now, earlier in the year, we had a lot of talk around New Zealand-Australian dollar parity. That seems to have really gone now. I mean, we're down to about 93 Aussie cents today. I mean, is that off the table for the time being?
Look, I think so. I mean, we were pretty close. We got up to sort of 99, 80, and for a while there, it seemed as if we were going to crack up to parity and didn't quite get there. And in the last 4 weeks or so, the outlook for interest rate policy in New Zealand has definitely changed. So, and the feeling is Australia is going to sort of hold around the 2% level. Again, I still think the Reserve Bank of Australia are going to maintain an easing bias and continue to leave room for further interest rate cuts. The RBA continue to want to see the Australian dollar lower for longer to give sectors outside of mining and resources an opportunity to pick up the slack. So I continue to see an easing bias in Australia. that means that the differential between New Zealand and Australia, our cash rate's at 3.5, theirs is at 2%. And if you look around the world, a lot of central banks are either still easing or still maintaining record low interest rates, whether it's in the UK where interest rates are at 0.5%, or Europe where interest rates in some parts are negative, and you've got this massive monetary stimulus. Obviously, the only country with a clear sort of tightening bias is the US, and that's coming off record low interest rates, which are currently 0.25%, 0 to 0.25%. So we are sitting out there alone, really, in many respects, in terms of a developed economy that still has very, very high interest rates relative to many of our trading partners.
Yep, a lonely place to be, yet we're popular. Now, look, you mentioned the Fed. Now, that's obviously the ongoing sort of story in the background, or not in the background, in front of mind very much so this year, is what's the Fed going to do? Expectations that they will hike for the first time in 9 years. June was all the talk for a while. We're in June now. We've got an FOMC meeting on the 17th and 18th. Mm-hmm. Doesn't seem to be an expectation that there'll be a hike then, but are we still looking at one from the Fed this year?
Yeah, I mean, it's amazing how quickly the year rolls along, and suddenly we're in June, and this was the time the Fed were expected to raise interest rates. The market isn't expecting that to happen. The market has now shifted the first rate hike from the Fed out to September this year, so we do expect them to raise interest rates before the end of the year, so it'll be September or December. I guess at the end of the day, the market has sort of stepped back a little bit and said, well, the timing of the first Fed rate hike probably isn't as important as how aggressive they go moving forward. So into next year, how many times they actually hike interest rates, which they are going to do. I think that's a given. They've flagged it to the market. They've had the follow through in the economy for them to justify hiking interest rates, and I think the time the time has come for sure. So it'll be interesting to how aggressive they start to raise interest rates after they've gone the first time into next year, and also how the global economy responds to that, because everyone's pretty addicted to this cheap credit, and the bottom line is the Fed set the tone for global credit demand, really, at the end of the day. That's going to be interesting. Obviously, equity markets are still ramping along at record highs in a lot of countries. Asset prices across the board are, in equities and the housing market and whatnot are still very, very strong. So I think the Fed, to maintain any credibility, has to raise this year, but not in June.
Okay, well, we'll keep an eye on that one. Now, there's a bit of a game of cat and mouse going on in Europe with the Greeks and their various creditors. Another 1.6 billion euros that Greece is scheduled to repay in the next couple of weeks. Are the markets even really worried about this now? I mean, Greece is still making a lot of headlines, but the euros seems to be a bit stronger, and there's talk that they're going to default, they're not going to default, but everything seems to keep ticking along now.
It does, and it's. If you go back a few years ago, any sort of whisper of a Greek default was causing carnage in financial markets. But we've come so far to where we are now that everyone is almost expecting that a Greek default is probably more likely than not, and they can continue to kick the can down the road, but they just don't have the money. They don't have the money to repay the creditors. I think they're talking to the IMF and the ECB and Greece and Germany and France at the moment, trying to probably stitch together some sort of deal. But I think everyone is coming to the conclusion that there is going to be some form of default from Greece, and whether they get kicked out of the Eurozone, I don't know. It's going to be an interesting one when and if it actually happens.
But the world will go on, I guess.
Yeah, I think the world will go on. I think there is definitely a little bit more resilience out there, and maybe in a way, you're seeing some decent growth across Europe. Obviously, you've seen places like Ireland come a long way since the middle of the GFC or the European financial debt crisis. Spain and the UK are recording some pretty decent growth. So perhaps Europe is in a stronger position to withstand a Greek default, and global investor sentiment isn't as fragile as it once was. So maybe timing is key.
Just finally, if we wrap up back on the Kiwi dollar, with that, I guess, easing bias at the Reserve Bank here and the tightening bias at the Fed, how low might we see the Kiwi against the greenback in coming months? And is this a good opportunity for exporters to lock in their hedging?
Yeah, well, we're at 71 cents against the US dollar at the moment. Look, I think we've got potential back under 70 cents. It's not going to take much. If we get confirmation of a clear easing bias and we see some weaker data out of New Zealand, I think we can easily be into the high 60s. I think that would be justified. It certainly starts to look quite attractive for exporters, though. I don't think many exporters would have been budgeting off a sub 70 Kiwi US this year. I certainly know that importers weren't. In terms of the New Zealand dollar against the other cross rates against the pound, we're trading at around 4 or 5 year lows against the pound sterling, trading around sort of 46 at the moment, and that to me looks like it's got clear downside potential. The UK economy is sort of pushing along, and there's more chance of rate hikes in the UK over the next 6 to 12 months. So, look, I think exporters have to do what's right for their business, particularly if they've budgeted off certain levels and they can lock in gains. An exporter taking out a forward contract for 1 year at the moment, selling US, buying Kiwi would be getting under 70 cents, which is remarkable, really, considering 12 months ago or so we were trading at 88. So it's amazing how quickly the currency can change, and obviously businesses need to be able to respond to that.
Yeah, absolutely. Thanks a lot for that, Dan. That's Dan Bell, Director of Sales at HiFX, and I'm Gareth Vaughan at interest.co.nz.